Chances are you or someone close to you works for a private American company. That's because 99% of U.S. companies are privately held. For decades, many of these companies relied heavily on banks to finance their growth and help run their day-to-day operations. But since the financial crisis, new rules and regulations are generally making it harder for banks to lend to private companies. As a result, many of these companies are looking for alternative sources of financing, creating a significant investment opportunity. How? Through a BDC, or business development company. It's a type of fund that acts as a lender to private companies, lending money similar to a bank. Back in 1980, Congress created BDCs to help private middle-market U.S. companies raise money from individual investors. Since then, BDCs have become an increasingly meaningful source of capital to help finance and grow American businesses. So how does it work? A BDC, similar to a mutual fund, pools together assets from a group of investors. That money is used to invest primarily in the loans, bonds, or equity of private U.S. companies. Generally, at least 70% of a BDC's assets must be invested in private U.S. companies or public companies valued under $250 million. BDCs are highly regulated under the Investment Company Act of 1940, which means investors can expect that a BDC's portfolio holdings and the estimated value of the fund are disclosed in periodic filings with the SEC. Also, an independent board of directors oversees fund management, and an independent custodian holds all of the assets. These measures are designed to provide transparency and oversight and help to protect investors. BDCs may vary in size or strategy, but all must distribute at least 90% of their earnings to investors. This could mean a high level of current income compared to other investments, especially in today's low interest rate environment. However, income could be a return of investor capital. Some BDCs focus primarily on providing loans to private companies. The interest income from these loans is passed through to investors. With less competition from banks, BDC managers may be able to negotiate investment terms that may not otherwise be available in the market. This might include an enhanced yield, discounted pricing and underwriting fees, and other contractual protections, all of which may translate into higher potential returns for investors. Plus, the investments within a BDC may be less correlated to traditional investments like stocks and bonds. This may diversify an investor's portfolio and smooth out volatility. Is a BDC right for you? Consult with your financial advisor to find out. Remember, working with the right advisor is a vital part of a sound financial plan. An investment in a BDC involves a high degree of risk and may be considered speculative. You should carefully consider all of the information and risk factors contained in a BDC's publicly filed prospectus before deciding to invest.